Harry Markowitz has been one of the most important researchers in capital markets and investment portfolio construction. In addition to winning the Nobel Prize in economics, his theories support the development of investment portfolios, considering not only expected returns, but also the level of risk that can be assumed. We will review his biography, his theory of optimal portfolios, and also attempt to evaluate which assets have the least correlation with the S&P 500, to establish which assets may be strategic in periods when the American market is possibly overvalued. Harry Markowitz was born in 1927 in Chicago to a family of Jewish origin. From his early years in school, Markowitz demonstrated good academic achievement. In addition to his academic work, he enjoyed football and baseball and also possessed musical talent. Markowitz particularly played the violin in high school. He was an avid reader since childhood and enjoyed reading comic books and comics like The Shadow. Since high school, he enjoyed popular stories on topics related to astronomy and physics. In high school, he began to delve deeper into the areas of physics and philosophy. Initially, he showed considerable interest in the positions of philosopher David Hume, who was highly critical of rationalism and whose philosophical stance was empiricist, postulating that knowledge of the world should be based on experience and rejecting metaphysics. Along the same lines, Markowitz became interested in the theory of the origin of species and Darwin's explanation of facts related to evolution. At the University of Chicago, he continued his studies, completing an undergraduate degree in just over 2 years. Later, at the same University of Chicago, he specialized in economics. In academia, he had the pleasure of studying with professors who were economic heavyweights. For example, Milton Friedman, a liberal who advocated economic freedom and disagreed with the power of states, monopolies, and unions. He also maintained that the only responsibility of corporations was to their shareholders. Jacob Marshak and Leonard Savage also shared classes with Markowitz. At the University of Chicago, his favorite area was the economics of uncertainty, where he became interested in the foundations of expected utility proposed by von Neumann, Morgenstern, and Marshak. While still in college, he was invited to join the Cowles Commission, which promoted quantitative analysis in economic research, proposing various econometric models that were quite innovative for the time. Markowitz decided to study how to use mathematics in stock market analysis for his thesis. His advisor was Jacob Cowles, the founder of the Cowles Foundation. This thesis was based on his theory of investment portfolio management, which seeks to construct optimal portfolios with different assets, taking into account both return and risk. Markowitz considered John Burr Williams's value theory of investment, but found that this model failed to consider or analyze the impact of risk. Furthermore, Williams considered only the expected value of individual assets in portfolio, disregarding risk. In his theory, Markowitz proposed a model for portfolio allocation under conditions of uncertainty, considering risk as variance. Markowitz proposed how diversification in a portfolio reduces risk in the assets that comprise it have low covariance, meaning having different assets that are uncorrelated in their prices. His final work was the Modern Portfolio Theory, MPT, or Efficient Frontier, in which the risk of a portfolio should be taken into account for all its component assets. His proposal was well received in the academic world and was published in 1952 by the Journal of Finance. By 1952, Markowitz landed a position at the Rand Corporation, where he had the opportunity to continue his economic research in the field of capital markets management. At this corporation, he worked alongside George Dantzig, one of the fathers of linear programming and the simplex method. Together, they sought to develop a critical line algorithm for identifying optimal portfolios, a model later called the Markowitz Frontier. He also worked for General Electric, assisting in the construction of manufacturing plant models. By 1955, Markowitz earned his doctorate and continued his research in portfolio theory. Markowitz sought to study how mathematical and computer science techniques could be used in practical problems, particularly to propose business decisions under uncertain conditions. In the mid-1960s, he returned to Rand with the goal of developing a programming language later called SimScript. Markowitz's contributions to the study of investment portfolios and corporate finance methods led him to receive the John von Neumann Prize in Theory in 1989 and the Nobel Prize in Economic Sciences in 1990, along with William Sharp and Merton Miller. One of the models derived from Markowitz's theory was the CAPM Capital Asset Pricing Model, which is also based on risk theory. His contributions can be found in the book Portfolio Selection, Efficient Diversification. Markowitz's Modern Portfolio Theory, MPT, theory seeks to organize portfolio allocation and distribution, taking into account both return and risk. The theory proposes how the risk of an investment portfolio can be substantially reduced through diversification. It is proposed that holding different assets that are uncorrelated or that have a low or negative covariance reduces risk. To measure the correlation between assets, one can assess whether the covariance is low or negative. The theory proposes that investors generally do not consider risk, and that if two portfolios are held, investors generally prefer the one with the highest potential return. With his theory, Markowitz sought to establish an efficient risk frontier, since each investor has a different risk tolerance. Each point on the efficient frontier curve represents the optimal weighting of the assets that make up a portfolio, seeking a balance between the risk assumed and the expected return. In his theory, Markowitz explained how the expected return on an investment could be obtained by calculating the expected future values of the returns on financial assets, brought to their present value. Risk can be measured by taking into account the volatility of the assets, which determines how variable the portfolio's returns are relative to the mean. It is assumed that higher volatility is associated with higher risk. A statistical tool for measuring risk is the mean variance, which measures the dispersion of the data relative to the mean. The objective is to try to minimize these values in order to reduce risk. Another important element was that the risk of an asset should not be assessed individually. Rather, risk should be evaluated taking into account the total contribution of each investor's portfolio. To determine the best portfolio, it is important to consider investors' attitudes toward risk, as some investors are risk tolerant and others are less tolerant. This element must be taken into account when selecting the assets that make up the portfolio. The concept of the efficient frontier is then applied to take into account investors' risk tolerance. For example, in this graph, investors with a higher risk tolerance would prefer option C, but more conservative investors would prefer option B. The objective is to try to construct an optimal portfolio that seeks a balance between return and risk using the investors' indifference curves. The optimal portfolio is constructed with financial assets that reduce the level of risk and maximize return, which corresponds to the efficient frontier. The optimal portfolio would be located on the tangent drawn to the efficient frontier, where the best possible return is achieved with a selected risk level, taking into account that each investor has a different risk level. To put the Markowitz model into practice to construct an optimal portfolio, historical data on the assets to be included in the portfolio must first be obtained, using the return and volatility of each asset as the main variables to measure the risk level. One element to consider is the investor's time horizon. If a person is thinking about investing for retirement, their time horizon may be a decade or more, while others may have a 3-year horizon. The assets that make up the optimal portfolio are then selected with an appropriate level of diversification, including assets that are not highly correlated. An asset's beta measures an asset's risk relative to the overall market. A stock with a beta greater than may first lose more value during corrections than a stock with a beta less than 1. To assess the correlation of these assets, a correlation analysis can be performed to identify assets with a low correlation by measuring the covariance between assets. Each investor's attitude toward risk tolerance is then assessed. In some cases, different restrictions must be defined depending on the risk profile to exclude certain assets with high volatility. Using the selected and excluded assets, the optimal portfolio is composed to minimize investor risk, depending in any case on the investor's risk level. The objective is to determine the efficient frontier that considers the level of risk, the assets chosen, and historical returns, calculating the variances of each individual asset and the covariances between the different assets in portfolios. Considering that the efficient frontier can change depending on changes in asset volatilities and returns, portfolios are periodically rebalanced to account for changes in asset returns and risks. The ultimate goal is to construct a portfolio that strikes an optimal balance between maximizing expected returns and tolerable risk. One of the benefits is reducing the risk level of the investment portfolio through diversification with a composition of different assets with low correlation. The goal is to enable investors to determine the level of diversification and the assets that best suit them. It is essential that portfolios fall within the efficient frontier. Otherwise, the portfolio is suboptimal because it entails either a very high risk relative to return or a very low return relative to risk. It is important to consider that in practice, the MARKOWITZ model is limited because asset returns often do not have a normal distribution. Furthermore, the correlations between the selected assets are dynamic, showing changes over time. For example, let's assume that portfolio A has an expected return of 9% and a standard deviation of 7%, while portfolio B also has an expected return of 9% and a standard deviation of 9.5%. Portfolio A is considered more efficient because it has the same expected return but with lower risk. One of the elements taken into account when constructing optimal portfolios is the correlation of assets, which can be measured with the correlation coefficient. The correlation coefficient varies between -1 and 1. A coefficient of 1 indicates a perfect correlation, where both assets are strongly correlated, meaning they both move in the same direction, up or down. A correlation of 0 implies no relationship. A negative correlation indicates they move inversely, and as one asset increases, the other tends to decrease. Another well-known investor who seeks to have a portfolio with assets with low correlation is Ray Dalio. He determines the assets in which to invest by dividing the different stages into 4 quadrants, depending primarily on 2 factors: economic growth or recession and the increase or decrease in inflation. The goal is to have a portfolio with uncorrelated assets or with low level of correlation, to try to balance the decline of one or more assets with the recovery of others that perform better at certain times, depending on the previously reviewed economic conditions of economic growth and the level of inflation. As an example, let's examine the correlation between different assets, such as the S&P 500, represented by the SPY, the TLT, which are long-term bonds, gold, represented by GLD, a small-cap indicator from the Russell 2000, the IJR, which includes small companies listed in the United States, a micro-cap indicator, the IWC, which includes the smallest publicly traded companies, an emerging markets index, the EM, and a Chinese stock market indicator, the SSE. In the case of the S&P 500, we observe a correlation quite close to 1 with respect to small caps, micro caps, and emerging markets. This means that both assets likely move in the same direction, increasing or correcting over time. There is a correlation close to 0 with gold, meaning the S&P 500's performance bears no relation to the gold price. And there is a slightly negative correlation with long-term bonds. The table also shows the standard deviation for each asset. It can be seen how, for example, Chinese stocks have a higher deviation than the S&P 500, as do emerging market indices and small-cap and micro-cap indices. Bonds do have a lower deviation than the S&P 500. Remember that this is another element that should be taken into account when constructing the optimal portfolio depending on the risk level appropriate for each individual's profile. However, it is important to keep in mind that correlations are dynamic over time. For example, a detailed review of the correlation between the S&P 500 and long-term bonds shows that in 2014 and 2015, a negative correlation of around -0.6 was observed, implying that when one asset was rising, the other fell. This other table shows a correlation between the S&P 500 and other assets. It is quite interesting to note how there is a negative correlation close to 0 with cash and a negative correlation with currencies. Another interesting exercise is to review the correlation between the S&P 500 and different sectors. We can see how the highest correlation, or close to 1, is found with the industrial and technology sectors, while the lowest correlation is found between the S&P 500 and utility sectors, which mainly include public service companies such as electricity, gas and water, and the energy sector. Remember that in the video description, you'll find a link to the best course for learning technical and fundamental analysis for investing in stocks. You'll also find a link to the best platform for buying stocks on the U.S. regulated stock exchange.